This is Silicon Valley real estate market for the February 14th, the ending Friday the 13th. These are the key chapters we're going over. If you want to get the data without listening to my yammerings, you can go to slide 60 and we'll get right into the first data slide. Here is the turnover rate. That's the purple line. You can see that we're a little bit slower than normal. We're about 108%, 8% longer than the normal turnover time for this same week for the past 10 years. This now is looking at the number of offers accepted. You can see that we're still below the typical number of offers accepted, but we're doing the best that we've had for the last 3 years. 2023, 24, and 25 were all below 90% the entire year. And you have to go all the way back to about September 1st of 2022 before we had more volume compared to the previous 10 years. And that was even short-lived. So if you even want to come all the way back and say you have to go back to May 1st, roughly, of 2022 to have this volume of transactions, that's fairly accurate. I don't know what's happened to the volume of transactions other than we've had a lot of people that have 3% mortgages and it's way more expensive for them to move. And also in the Bay Area, you have a lot of people with huge amounts of capital gains if they sell, even with the 250 per person exclusion. And the third quick indicator is active inventory. Active inventory is the gray line up here. You can see we're about 8% more inventory. So buyers actually have a little bit more choice, and that's more choice than buyers have had for about the last 3 quarters. That's been right around normal, except for right at the end of the year when there was a shortage of inventory, and now we're a little bit above normal at 8%. Here now is the same sort of metrics over the past 13 weeks, past quarter. The trend data goes into the future for 13 weeks. The trend data is based on the median for the past 10 years for the same week, for the same metric. The gray is the typical, that would be the median. The blue is the side of the extreme, either the 10 or 90% that favors the buyer. On turnover rate, a slow turnover rate favors the buyer, so that's the 90th percentile. The red is a very fast marketplace, which would favor the seller. So that's the 10 percentile turnover rate. So the concept's the middle. In the middle of the graph is the current data. The purple line is the last week that we have current data for, which obviously is true. I don't have next week's data until next week. Turnover time, you can see right now you're at 35 days basically. Typical is 34 and a half. And if you're really talking about the first decimal, you're even closer than that, 34.7 versus 34.5. So you're exactly normal, 0.6% above normal. And in the real estate market, that is absolutely normal. Now, marketing, and that's the theoretical rate of how quickly you turn over the inventory one time in the current market rate, given the current inventory. Marketing time is related, but completely different metric. It's how long are 3/4 of the sellers taking to sell their property. We all know in the Silicon Valley, about 50% of the sellers come on the marketplace, sell their house the first weekend, and get on with life. So we're sort of taking the median of the 50% that don't sell that first weekend, and now they're selling in 15 days. You can see that that's down on the red hot line, which is the hottest you'd expect, which is exactly 15. Typical for this time, for this same week, year after year, is 40 days. So you're 1/3 the time that it's normally taking for 3/4 of the sellers selling. Why the huge discrepancy? Frankly, just from personal observations being active in the business, it seemed like we were getting a lot of less desirable properties at the end of last year. That's what held over. All the desirable properties that are coming on since the beginning part of the year have had 0 days on marketplace. So your time to reach that 3/4 is a lot lower. And yes, I do believe that the less than desirable properties was a greater percentage of the market at the end of the year this year than it normally is. No explanation on why. It's just, and it could be just my own business, but, backing up to freeways, backing up to expressways on busy feeder streets, things of that nature, things that are not considered ideal situations for a lot of the buyers. Seller ask price reductions, that's almost dead on normal, 0.6%. Normal is 0.5%, so a 10% difference. That's pretty minor, but it's enough that it's 20% more, larger price reductions than normal. So it's a small number. And the reason it's such a small number is, again, most sellers do their homework before they put their house on the marketplace. They put it on and contract to sellers. 50% are selling that first weekend. They don't have time to reduce their price. Buyer overbidding. This is the competition buyers are feeling. That's been probably the most steady indicator we've had in a long time, right on normal. And it continues to be right on normal. What's that mean? It means that buyers on average are overbidding the seller's ask price by 4.3%. And this is for all of Silicon Valley, which is Santa Clara, San Mateo, and Alameda counties all in a blender, which isn't what any one person is experiencing, because each micro market that we'll be getting into later is different, and your market conditions are based on the micro market, not on the overall conditions. But this is to give you an overview of where the market is and where it's likely to be going. And the be going is based on the future trends. Offers accepted. This is basically the number of offers accepted. You can see we've been basically right on the blue line, which is less offers than you would normally expect. You can see we're approaching the gray line, the typical line. You can see we're at 91%. We're selling 1,550, call it, transactions, and normally you're just shy of 1,700. So you're still missing about 150% or about 10%, which is why this is at 91%. And this gives you the range. Sluggish market, the least number of transactions is down there at 1,300. The most you'd expect is at 2,000. We're sort of in the middle of it right now, but we're still missing the market. We've been missing the market ever since the peak of the marketplace back in 2022. Inventory, where's inventory? It's exactly normal. You can see it was normal up until maybe about Thanksgiving. Then at the end of the year, we were really missing out on inventory. And now we've recovered the last couple of weeks and we're back to normal levels of inventory. And transactions, this is simply tracking the number of closed transactions. It's a very lagging indicator, but again, it's important because that's what the industry runs on. How many title insurance policies were issued, how many loans were likely issued, how many home inspections were made, and things of that nature. You can still see we're missing a good chunk of the marketplace at only 78% of the volume that you'd expect. We're at just shy of 1,000. You'd expect to be at 1,250. Here now is those micro market areas. And these are, starting on the left-hand side, the yellow highlight are leading indicators, your turnover time, the marketing time, the price reductions, frequency, magnitude, and frequency. The overbidding is orange and highlight because it's lagging. I need the sold price. So that's going back in 5 weeks for the typical escrow to close. And then the green is the year-to-year comparisons. So if you look at this, here, price reductions, the frequency of them is red in color, which means there's less frequent price reductions than there typically is. But other than that, maybe marketing time is clearly a little bit redder. But other than those two indicators, the bulk green in color, which is absolutely normal. It's fairly close. It's a pale shade of blue, pale shade of pink, one of the shades of green. That's telling you that the market's behaving very similar to the past 10 years. But if you come over here and look at the overall condition, it's all red. And how do I explain the difference? It's basically saying that Silicon Valley is normally a raging bonfire, and now we're just a hot fire. We're not that super heated marketplace, but we're still fast. So these numbers here are all red, so that you clearly have a marketplace that's favoring the seller, but it's basically normal. So the buyers are having normal experience out there, but unfortunately for Silicon Valley, at least, it favors the seller. Here are some definitions for the chapters that are coming up on the micro market conditions. Here now is the first micro market map. This is the turnover rate. This is how quickly does it take to sell the inventory one time. This is the color code from a red hot seller's marketplace to an ice cold buyer's marketplace. So you can see the different colors that I'm using. I'm using set increments instead of calculating each one, and I do that via table lookup. And you can see, Santa Clara County is basically red. San Mateo County is mostly red, but you got some greens in there. And then Alameda County is a little bit more mixed. You got some blues, you got some deep blues. Look at Alameda County. It goes from 120 days, call it, to 10 days. And there's no way the buyer's experience is going to be the same if the market's turning over once every week and a half versus it's taking, what would that be, 17, 18 weeks to turn over one time? Huge difference. And that's why, to me, the micro market data, yes, you look at the global data to get a feel for what the market's doing, but when you're actually trying to make a decision on what you're feeling in the marketplace, is it real? You need to look at the micro market data. This is turnover rate compared to the normal. So you can see most of the area is close to that neutral color. The hottest areas we're having is right here. It's sort of the Los Altos, Palo Alto area right now. And surprisingly, the coast that has been extremely slow is showing up here as being quicker than normal at 78%. So their turnover rate on the coast right now is actually fairly good. Here's marketing time. This is the time that it takes 3 out of 4 sellers. This is an absolute number. You can see that your red in color, if it's 3 weeks or less, you can see the vast majority of the Silicon Valley is red in color. Yes, there are green areas which are normal, like South County and the Hayward area up here, but clearly it's mostly red. This is compared to typical. So where is it normal? And you can see that the whole East Foothills, all the way from Fremont all the way down to South County, is basically fairly shade of green, which is normal. If you basically take something like, call it maybe 17 up through here and the northwest of 17, that's mostly red. So you have large regions that are hotter as well as the micro markets. Look at the difference here in the expensive areas compared to Redwood City, or compare Saratoga, Las Gatos to Campbell, Willow Glen, Santa Clara. Huge difference in intensity of that redness. Here's the reductions. This is magnitude of seller price reductions. So how big are these? Now look at the numbers of here. We're not talking large numbers. We're talking about the maximum I would expect is a 5% reduction. And your blue in color, if you're taking even a 1% price reduction. Normal is only from a minus a 0.25% reduction to 1% reduction, a very tight metric. And that's one reason I don't particularly like the average price reductions, but here it is for you. And you can see it's a pretty much pastel color, which indicates that sellers are doing about average magnitude price reductions. This is compared to typical. And again, it's pastel colors, it's shades of green, completely normal on price reductions. So sellers are behaving normally. Now look at the frequency. It's bright red. How can I resolute those two? The sellers that are taking those price reductions are taking larger price reductions than they normally do. So the average, even though it's a fewer number, the average is coming out normal. But look at the frequency. I mean, that's one of the reddest sharks I've thrown up there. And it's bright red, which means you're up here with less than 17%. Look at some of these numbers in Santa Clara County, 3%, 4%, 3.5%, 7% of the sellers are doing price reductions. Go down to San Mateo County, 0, 4.5, 6, 6.5%, 2%. I mean, those are low numbers. Even down here in Alameda County, the highest number I'm seeing right off the bat is 20%. Now, if 1 out of 5 sellers doing a price reduction is normal, but it's still a small number. The highest number I'm picking up on the whole area is South County, with 1 in 4 sellers doing a price reduction. Here's the frequency compared to normal. So red. So again, sort of like the previous chart, even though the previous chart was bright red, which said very few sellers are doing it, this is sort of a moderate red. So it is fewer than normal, but there are areas like Fremont where the normal frequency is absolutely normal. Fremont, Union City, Newark, the Tri-City area. Moving on to overbidding. This is the pressure the buyers are feeling when they're making their offer. You can see that a lot of the area is red, at least the pink in color. Now your Allen Rock, Central San Jose, South San Jose area is green. But what are you talking about there? 1/10 of 1%. So their buyers are still overbidding. It's just a small amount. But if you go down to South County, the buyers are actually taking a price reduction of 0.2. Go over to the San Mateo County coast, 2 full percentage points. And that's why I was a little surprised to see the turnover rate so fast. The coast has been slow for the last several months. Here's overbidding average versus typical. So again, it's fairly typical. Where are you seeing more overbidding? In the Los Altos, Palo Alto area right at the moment. The central part right along the 880 corridor is a little bit pinker than normal, but it's fairly pink, it's fairly normal. This is the frequency. So how common is overbidding? You can see that 71% of the sellers in Cupertino are getting, I'll call it 72% in Cupertino all the way through Santa Clara. That's almost 3 out of 4 sellers are getting more than their asking price. Jumping down to San Mateo County goes all the way from 81% down to 33%. So there's quite a range. Alameda County, the range is in 37 to 60%, not as great as in San Mateo County. This is the frequency of overbidding by the buyer. So how common is it? You can see it's basically pastel color, maybe be a little bit of blue just because you have this chunk of blue down here and a chunk of blue up here. But I would call that absolutely normal. What are you talking about normal? 13% more overbidding, 12% less overbidding, 30% less overbidding. So, 45% more overbidding. So it's on both sides. And when you have, again, one county where you're going from 70% to 140%, that's a doubling of the normal amount of overbidding. And so, again, a good example of why micro-market data is important. Here's appreciation. This is long-term since 2015, the last 9 months. The areas that have had the most appreciation is Newark and Union City. Central Silicon Valley is right up there. Redwood City looks like it's up there. And the actual percentages are up here. So this is the amount of appreciation. The highest number I'm seeing is down here in Newark and Union City at 105% appreciation. You've more than doubled your money. And the area that's got the least amount of appreciation right at the moment is Foster City. And Foster City, you know, it's showing up so many times, I should just take it out, but I'm hesitant to do that. It's such a small micro market area. It's only like 4 or 6 houses. So the fact that you're at 14% appreciation is market mix, not that you've only had 14% appreciation. Here's the price, and instead of following just the median number, which is the middle number of each micro market area, I sandwich it with the cheapest 10 percentile you'd expect to find in a given area, along with the most expensive 90 percentile that you'd expect to find in a given area. So that's I think that's more useful for consumers out there to have some idea what the expectations, the price range, instead of just having one number to follow. Here's the offers compared to normal. You can see that we've had some areas like Milpitas right now at 6% more offers. Look at Los Altos, 33% more offers basically than they would expect based on the past 10 years. On this slide and a couple other slides, I only have county-wide data for Alameda County. Here is the active inventory. So you can see that, again, we're green and pastel colors. So you basically have the normal level of inventory. For Silicon Valley, you can see it's 8% more than normal. Santa Clara County is 15%. San Mateo County is 5% more, and Alameda County is right at the normal level of inventory. Here's a summary chart again. I sort of went over that at the beginning, so it's just up here for a recap. Here's some more definitions of what we're going into next. And basically what we're doing here is we're comparing the purple line, which is the current data, to the past 10 years with the trend data. The gray line is where you'd expect the market to be. The blue line is the least, the line that would favor the buyer the most, and the red is the line that favors the seller the most. This is the turnover rate. So the turnover, the speed of the marketplace, the flip rate of the marketplace, you know, sort of how quickly do you turn your inventory, is essentially right at normal. And the purpose of these lines, you know, a lot of horizontal graphs are defaulted as horizontal lines. Well, real estate is so cyclical, the gray line is really what your line is. That's where you'd expect the market to be. So the difference is on how close or how far away you are vertically from the gray line. And since that's sometimes hard to tell, I do it on a percentage basis. So here you can see your turnover time right now is 8% longer than you'd expect based on the previous 10 years. Same concept with marketing time. Look how fast that is. That's the fastest you'd expect it to be, right on top of the red line. Here, look at this. And now this becomes interesting. Look how you're basically, the time for the sellers to sell is like 38% of the time it normally takes. The only times we were that low were basically here in 2025, right at the beginning part of the year, similar to 2026, close in 2024, close in 2022, close in 2020, end of 2020, which was interesting, and way back in 2018. It's not uncommon to have this huge race up in marketing time at this time of the year, but it's also not very long lived. So it's just in another week or two, you'd expect this number to turn around, or I'm going to have to expand my graph below 30%. This is the price reduction metric I personally like, which is the 97.5th percentile. It may sound like a bizarre metric, but basically what I'm looking at is I like looking at the 15% of the marketplace eliminating the top 2.5%. So I look from the 97.5th percentile down to the 82.5th percentile. This is telling you the sellers that are taking the largest price reductions, what are they doing? And right now they're taking somewhere just over 10%, about 10.5% price reductions. Now, just a few weeks ago, right at the end of the year, they were taking almost a 16% price reduction. And when you're talking about median prices around $2 million, like we are in Silicon Valley, a 16% price reduction is a third of $1 million. That is not small numbers. Here's on a percentage basis. You can see that we were taking larger price reductions. Now we're going basically rapidly going back up to that normal level. We're still taking slightly larger price reductions than we normally do. And this is based on the average. So I flipped from 97.5 to the average. And here's the percentage of normal for that average. So I put the 97.5 percentile on there because I like it. I'm putting the average on there because it's a more common metric. And, I want to show people that I'm not playing around with statistics. That's one of the things statisticians get accused of doing. Here now is looking at the frequency of the price reductions. You can see that the purple line has been diving down in the last couple of weeks. You were up here, you were above the normal. Now you're slightly below, but you're diving down at the time the market normally dives down. Look at the all color lines, the red, the gray, and the blue. They're normally diving down at this time of the year. So the fact that the purple is diving down isn't really saying the market's changing and something to be aware of. It's saying the market's behaving absolutely normally. Here now is on a percentage basis. So you went from somewhere about 10% longer, more frequent turnovers to now somewhere around 15% less price reductions. So clearly a shift in the marketplace when you look on the percentage basis. On that steep graph, it's hard to see that change. And again, this is one of the reasons I plot both metrics. Here's the median. It's, I think, the only data slide where I talked about the median overbid. Right now, you're at 1.5%. So half the buyers are bidding more than 1.5% above the seller's ask price. Half the sellers are bidding less than 1.5% above, and that includes below. But remember, this is where the market was 5 weeks ago. 5 weeks ago was right at the end of the year. This is the time of the year where you're starting to see the change, and look how quickly the gray line climbs. In another couple of weeks, I expect to be up from a 1.5% overbid to 4% overbid. Will it go up higher than that? It's hard to go up higher than that, but it could. Where you're going to start seeing the overshoot is basically 5 and 6 weeks from now. Are you going to come up in this area, or are you going to plateau? Because right now it's climbing about as rapidly as it can. Here's the overbid versus typical. And this is simply, instead of doing a percent on a percent, is the percentage overbid more or less than normal? So right now, the amount of overbidding we're getting is about 0.4% more than normal. And you can see that it's been normal for all of fourth quarter of last year and so far all first quarter of this year. Also, I don't think I've mentioned this week, basically the green line here is to separate the x-axis. To the left of the green line is condensed scale, where each, from right where the cursor is now to the green line is 1 year. But 1 year to the right of the green line, 1 year goes from where the green line is out to the cursor over here. It's double the distance, and that's so you can see trend. My goal is to have the 10 years of data that my metrics are based on, which is basically January 1st of 2026 back in time for 10 years to January 1st of 2016. So you can see all the data, and then you can see that how I get the median and average. And I'm comparing the same week to the same week. Here's the frequency of overbidding. You can see we're right at normal, and we're climbing steeply right now. Right now, it's about, well, I'll call it 58%. It's a little bit higher than that. But right now, almost 60% of the sellers are getting more than their asking price. And again, that's back in time. The reason it's back in time, the access to the data doesn't exist until escrows close. Here's compared to normal. You can see that we've been climbing back. You go back to mid of third quarter last year, you're down 75% of normal. Now you're basically right at normal. So buyers are overbidding as you'd expect them to be overbidding. Here's a price model. You can see we're on the low side, but we're at the low side right here. And I still believe this is a fairly accurate model. If you basically come to sometime here around June 1st of 2023 to present day, you have a few spikes up, but you also have a few spikes down. So the market's been basically flat. You don't have the climb that you've had for the 7.5 years back here historically before 2022. We got up to 2022 and we basically went flat. Yes, you had overshoot here in 2022 and some overshoot in 2024 and 2025. But for the most part, prices have been flat for the last, what would that be? That'd be 4 years. Here's offers accepted. You can see that we're down, and right now we are coming up a little bit. We're mostly at 80%. Right now we're at 90%, and that's why vertically you're between the gray line and the blue line. Again, it's hard to tell exactly where you are on this graph, but you do the best you can. And then here is the active inventory. You can see that active inventory is starting to go towards the blue line. It's above the gray line. And that's saying that buyers have a little bit more choice right now than they typically do for this time of the year. Here's some definitions going on to comparing the three counties. So now we're comparing the three counties to each other. San Mateo County is in the orange, Santa Clara County is in the blue, and Alameda County is in the gray color. This is the turnover rate. So you can see San Mateo and Santa Clara County are right together, turning over the marketplace in about 35 days. Alameda County is slower at about 42 days. This is looking at time to sell. You can see San Mateo County is hiding below Santa Clara County here. You can see it peeking out a little bit right there to the right of the cursor. So you're basically somewhere down around 14 days for San Mateo County. It looks like Santa Clara is 13 days. Alameda County is at 19 days. So they're all selling in less than 3 weeks. This is axe price reductions. So you can see San Mateo County is taking only 0.4%. Santa Clara County is taking about just over 0.5%. And Alameda County is taking the most price reductions at 0.7% price reduction on average. And again, this is more commonly used number. Frequency of price reductions. San Mateo County is doing the least price reductions at 6%. Santa Clara is next at 8%. And then Alameda County is doing the most at almost 11% of the sellers are doing a price reduction. That's only 1 in 10 of the sellers are doing a price reduction, and that's the one that's taking the most. So clearly price reductions are not very common. Overbidding. Alameda County has the most overbidding, and that is still noteworthy to talk about. Alameda County had and you can see Santa Clara and San Mateo County again are very tied, and they've been tied for almost every metric when we're looking at them side by side. Frequency, Santa Clara County has got a little bit more frequent overbidding, but again, very close. You go from the least amount of overbid in Alameda County at 52% to the most at about 56%. So very close, only a 10% swing out of the percentages. Long-term appreciation, Santa Clara County's got the most appreciation here at about 80%. San Mateo County is next at about 75% appreciation. And Alameda County's got the least appreciation, down around 53%, 52%, 52.5%, call it. Here is the sale price on log paper. You can see San Mateo County is pulling out in front with the highest pricing. Santa Clara County popping down here, and then Alameda County. Here's the same information on regular paper, which is so easy to grab the sale price. So Alameda County's median's about 1130. That'd be 1,130,000. Santa Clara County is at about 1,750,000, and San Mateo County is a nice even $2 million. Here's the payments. This is assuming a high balance conforming loan limit from the national average. You can do better than that. Conforming rates and jumbo rates right now are roughly the same, which is sort of a unique situation. Historically, jumbo rates were more expensive. In more recent time, jumbo rates have been cheaper. Right now, they're roughly equal at a lot of lenders. And you also have almost every lender now, every big lender is doing a banking relationship pricing for customers that have their 401k or stock investments at their affiliated stock market brokerage. Here's offers accepted. You can see Santa Clara County has the most offers being accepted at just over 650. Alameda County second at just under 600. And San Mateo is the least. It's not because it's slow or anything. It's just because it's a smaller county at 300 offers. And this is inventory. So you can see San Mateo County inventory is right about 300. It's about the same. All three counties, well, Santa Clara is roughly the same as its inventory. Alameda County is going to have the slowest turnover rate because it had the second highest number of offers, but it's got the highest number of active listings. So it's got the slowest turnover rate, and I believe that's true. I think the number was something like 40 days or 42 days. On this number, table is getting less noticeable. We're looking at the bottom line now. Now we got the seventh least amount of transactions out of the last 10 years. And the 22nd least out of the last 25. That doesn't alarm me. And it's interesting. Long term, we have been seeing fewer and fewer transactions. These numbers are down around 1,500. In my career, those numbers were up around 2,000. The long-term trend is for sellers to buy their house, stay in it longer. There's less number of transactions per consumer. Each consumer is having fewer transactions in a lifetime. And I think that's part of Prop 13, Prop 19, and capital gains tax. You're going to add on to your existing house versus sell, so you don't have to pay capital gains. We need to, in my opinion, we need to do something about the capital gains rate in order to turn over and free up some of these homes. Where a lot of the homes that are coming on the market are when the long-term family parents are passing away and their children of the parents that passed are selling the family home. And that's opening up nice family homes close to workplaces. But we have a lot of, and I'm not talking about forcing anybody to move. It would be nice to make it voluntary and give people an incentive to move out of their large family home with one person and let a larger number of people share that asset close to workplaces. Here now is the actual numbers. You have Santa Clara County, San Mateo, and Alameda County, as well as Silicon Valley overall. You can look at the actual metric that you particularly like. I have two different appreciation rates on here. I have the since 2015. I also have since the pandemic. Well, San Mateo County and Santa Clara close together since the pandemic, but you can see the Alameda County at 18% is really lagging behind. It is also lagging behind since 2015. But there is a bigger difference. Santa Clara County is at 90% versus 83%. So there's a 7% difference for San Mateo and Santa Clara County. And that's been my sense that Santa Clara County has been sort of catching up to San Mateo County. Here's some customization I can do for buyers that want to work out to me, basically add some information that's important to you in an easy to search format. We have been talking and we'll continue to talk about Silicon Valley real estate marketplace in the last 8 minutes or so. Is the greater Bay Area, 13 counties at 5 regions. The handout is up. You get to that by typing in the tiny root URL, the green root URL here, the letter H, the handout for handout 2026-02-14 for today's month date. And this is the correct link for those that want to get there directly without a secondary link. You can just type that in and it's up on Google Drives. If you want to join the presentation Saturday morning live at 9 a.m., you type in the green root URL in 2026 or the longer blue Zoom link. And the archives are all on my YouTube channel, or just the tiny root URL gets you there directly. I'm Richard Calhoun, real estate broker with Creekside Realty, working actively with buyers and sellers here in Silicon Valley in single agency transactions. Here's now we're moving on to the distributions. Here's some more definitions. Here's marketing time. This is looking at the transactions from 50%, and I don't go below 50% because look how grouped up the data is here. I go all the way up to the 90th percentile. And I focus on the 75th percentile. If someone wanted to focus on the 80th or the 85th percentile, I think that would actually be a sweeter spot. I just have too much data right now for the 75th percentile, so I'm not moving off that. The purple line is the current data. We're starting off a year ago on the dotted line, so you can see the market was quicker a year ago. And let's see where it goes. It goes 1, 2, 3, 4, 5, 7. And now it's slowing down. So we have about 7 more weeks where this line is going to be down in this realm, most likely before it slows down. And then after about 7 weeks from now, you can see it just climbs and climbs and climbs. And now it gets to the point where it starts to bounce a little bit. It really leveled off, and now it's starting to improve a little bit. See, look at that improvement. Now it's going to slow down, and now it's going to slow down to the end of the year. And also coming up here, you'll see that some of these slides here on the right, like, see how it's starting to get steeper on the right hand, right there, steeper, steeper. As long as that's steeper, you know the market's still getting faster. As soon as this top end here drops down and starts being flatter, like these other dotted lines in the past, you know that the market's actually slowing down. So there's different ways to see the data trends. Here's doing the same thing with the largest price reductions. Here's where we're going from the largest 2.5 percentile, so that would be the 97.5 percentile, down to the 82.5 percentile here. Same concept. We're starting off a year ago on the dotted line, which was the hottest line, Valentine's Day. And that corresponds to basically, in my opinion, the 4-year anniversary of the last peak of the marketplace we had on Valentine's Day of 2022. If you're going to disagree with me and say it was in April of 2022. I'm not going to argue that. It's just, it depends on what metric you use to define the top of the marketplace. Anyway, let's step through and compare this. There you can see we went up 2 weeks. That's the third week. So after just 3 weeks, it's already coming down. And then more noticeably after about 7 weeks. And then it just comes down and it steps through end of May, continuing to come down through June. Now it's starting to bounce. Now it's going to actually accelerate, maybe. Yep, right there's a little bit of acceleration for September and October. And now it's slowing down again in November. There's sort of the bottom of the marketplace. It's already heating up at the end of December. I think it's anticipation by the sellers of the new market coming. And there's the current week. So you can see we're slightly cooler than last year because we're taking more price reductions, especially right through this segment here and up at the upper end. The lower end is all, the percentage of sellers that are doing, actually that's different by 2.5%. So clearly a little bit slower, more price reductions this year than last year. And lastly, let's changing over and looking at the overbidding. This is the buyer competitiveness. And again, this is a lagging indicator because we need that closed price. But again, you can see that the dotted line, which is what we're going to start off with, is hotter than the current purple line, which is where we're going to end up. So let's step through and watch what happens. Look at that huge improvement, huge improvement. Now you're sort of at the peak during the month of March. And remember, that's lagging by 5 weeks. So that's really the month of February. Now you're already slowing down when you get in the middle of April and into May. And continue to slow down through July 4th. And even through all of August, into August and all of August. And now you're going to have a little bit of acceleration in September, which is really the end of August for market conditions. There's sort of the new peak at the middle of November, which is really the middle of October. And then at the end, hit Halloween, and you slow down for the balance of the year. Then you're going to wait until after the New Year's. There's January 31st, February 7th, and you're finally improving. So the bottom of the market is January 31st, which is about December 31st as far as market conditions. Now we're leaving the Silicon Valley area and going into the Greater Bay Area. I have the 5 regions and the 13 counties that make up those 5 regions and a few definitions for you. Here is marketing time, the turnover rate, actually. So looking at the turnover rate down in all 5 regions, down significantly in all 5 regions. And you can see that the peak happened about 2 weeks ago. And that was the peak slowness. This is the time to sell for the typical seller down in all regions. The slowest area now is 80 days for 3 out of 4 sellers to sell. The fastest is here in Silicon Valley at about 15 days for 3 out of 4 sellers to sell. Here's ask price reductions. Silicon Valley has the least amount of price reductions. On Central Coast has the most. The order is basically very similar for each different metric, but does change a little bit. Here you have Silicon Valley, followed by the cities, followed by Central Valley, North Bay, and the Central Coast. Now you're going Silicon Valley, cities. Central Valley went from 5th place to 3rd place. North Bay and Central Valley is actually ending up in last place with the most sellers doing their price reductions in the Central Valley. And what's actually interesting to me a little bit is you look over the history. And, the Central Valley is sort of near the top of the line, no matter what time of year it is. So that says that Central Valley tends to do more price reductions. Here's overbidding. So who's doing the most overbidding? Cities, followed by Silicon Valley, North Bay, Central Valley, and Central Coast has the least. 3 out of the 5 are still below ask price, and that being North Bay, Central Valley, and Central Coast. Only the cities and Silicon Valley are above asking price. Frequency of overbidding, Silicon Valley and cities is the highest at around 58% for the Silicon Valley and about 66% for the cities. Then you jump all the way down about 34% for North Bay, 30% for the Central Valley, and Central Coast coming in at 26%. That's just over 1 in 4 sellers. So you go from 3 out of 5 to 1 out of 4. And then this is appreciation. The cities continues to do the least well since the pandemic. You can see it really broke out here in 2020 before, and it actually started dipping down. You don't know if this was momentary back at the end of 2019, but basically since the pandemic early in 2020, The cities has been doing consistently the least well. The Central Coast is fairly close to the second best at the bottom. And on the upward side, you have the Central Valley doing the highest appreciation, followed by Silicon Valley. Now we're looking at the sold price, and this is just the median sold price of each of the 5 regions. The most expensive is the cities, followed by Silicon Valley, Central Coast, North Bay, and the most affordable is the Central Valley. What I find interesting is you come back here, and basically sometime in 2021 is when most of these areas first hit their price. Now, if you go up to the cities actually first hit their price way back in 2018. The Silicon Valley was 2021. Central Coast was early in 2021. North Bay was early in 2021. And the Central Valley was not till early 2022. But they're also all below their peak pricing in 2022. Here's the same information, but this is monthly payment using the high balance conforming loan from the national average, and you can get lower rates than that. And this is the number of offers accepted. You can see all 5 regions is turning around and climbing rapidly at this time of the year like they typically do. And finally, the active inventory is growing in all 5 regions. And here's the numbers. And unlike the earlier presentations, the now column is the current week. 1 week ago minus 1 week is the percent change from a week ago and the percent change from 5 weeks ago. Turnover time is actually longer than it was 5 weeks ago, but shorter than it was a week ago. Your time to sell is faster than it was 5 and 1 week ago. Your time to sell, I didn't realize I had both the median time to sell and the 3 quarters. I guess I decided to put the median on there. I'm not sure why I decided to put it on there. Maybe just so people would have a comparison. Price reductions, frequency, average, and magnitude. Overbidding lags behind because you need the sold price, appreciation, the sold price, the 10 percentile and the 90 percentile. And then I do the comparison only on the median because I'm running out of horizontal space, and then inventory, offers accepted, and then inventory. And with that, we've been talking about the Silicon Valley real estate marketplace, and we just finished up with the Greater Bay Area, 13 counties and 5 regions. I'm Richard Calhoun, real estate broker with Creekside Realty. Earlier on, I think it's slide 60, I went over this, so I won't do it again. Thanks for joining. Have a great week. Take care. Bye for now.